The interest rate for China's 10-year government bond just hit a record low. And the Chinese know what that means. It isn't stimulus. It's another very clear signal that the downside is accelerating, that faith in China's ability to turn it all around has run out. Stocks over there have sold off again. Reflation-sounding commodity prices have completely reversed, including steel in Shanghai, which just touched a 7-year low. That widely predicted global reflation is predictably rapidly falling apart as the latest economic data from the country comes in unexpectedly much weaker. And what is the Chinese central bank going to do about all this? They're going to sell government bonds, not US bonds, Chinese government bonds. Sell, not buy. They need to reverse what is a very clear negative signal from market interest rates. Officials are going to sell bonds to get rates to go up. The PBOC has indeed become the Fed. That's what all central banks have indeed become. When you don't like the way it's going, try to get everyone to just change the channel and ignore it. It's because the Chinese know there really isn't much that they can do. They've been throwing plan after plan at real estate and the economy, and nothing is working. The evidence for China's hard landing continues to pile up, and in all places. Economic data, bond yields, as we'll go over in just a moment, as well as critical commodities such as steel. As I just mentioned, steel prices in Shanghai touched a 7-year low. They rebounded today, but as a reflection of lack of optimism and faith in the rescue plans plural, that the Chinese have thrown around for the last year or so. Copper prices, they touched a multi-month low after having surged recently, but not because demand is resurgent, but because supplies were short. The Chinese ended up buying a lot of copper, and it has been building up in stockpiles all over the country. Equities, I mentioned stock prices in China. The Shanghai SSE is down sharply, as is Hong Kong's Hang Seng. Both of those timed peaking right around when China announced its historic real estate rescue. China's currency, we continue to come back to that one, still running around 727. It has flattened out more recently, the last couple days, as the PBOC has attempted to fix the midpoint central parity a little bit stronger Friday and today. The offshore yuan rate, 730 to the dollar, continuing to be weak there as well. But the most critical sign, China's government bonds. And it's not just the 10-year, it's all the bond rates and all the bond maturities. The 10-year, though, that one just hit a record low after the economic data that was released last night, and I'll go over that later in the video. But the 10-year hits a record low, causing the PBOC to announce that it is now going to be borrowing bonds from Chinese dealers, presumably to start selling them into the marketplace to try to interrupt the rally that's going on all across the Chinese bond market. What was reported is that the PBOC, after, quote, careful observation and evaluation, is going to be borrowing specific maturities from dealers that it might not have in its own inventory, because the Chinese central bank, unlike the Fed or ECB or Western central banks, does not have a huge stockpile of bonds in its inventory that it can reverse and sell them into the marketplace. It wants rates to go up because it wants to build confidence in the recovery, and as it currently stands, Chinese authorities know that low rates are associated with negative outcomes, which is true of all interest rates, no matter what they try to tell you over here in Western economics. But essentially, they want interest rates to at least stabilize, stop hitting records, because they want people to think that somehow there's going to be some magic bullet that will fix China's real estate sector and economy. But as interest rates continue to go down, safe and liquid and high demand, that does not fit with the idea that China is coming along in the way that authorities would like it to. So they're trying to build confidence in stabilization and recovery by selling bonds that they don't have. They don't have a lot of them. So we're supposed to be impressed that the central bank can borrow bonds from dealers, sell them, and control the marketplace. They're essentially like the Japanese government and its failed intervention in the yen. They're setting themselves up for massive amounts of failure. But that's really what this is all about. As I mentioned in a recent video, the PBOC has reformed itself from a monetary agency to the Western style central bank, where all it really does is try to signal to the economy and control signals, especially those it doesn't like. But with interest rates going aggressively lower here, it's going to take a lot to turn everything around and change people's minds because they can see what's happening. It's not just commodity prices or markets. China's economy is weakening in such a way that everyone can see it. Everyone except for, of course, Western economists. But before we get into how economists are so optimistic on everything with China despite the bond market, I want to let you know that Eurodollar University's anniversary sale is here. We've got low prices and huge savings on all EDU products. From the deep dive analysis where we go deep behind the topics we talk about here on YouTube, the daily briefing which gets you caught up on everything going on every day, and the memberships with tons of stuff for EDU's members. You can see all the anniversary sale details at our website, eurodollar.university. Despite all of the market signals from commodity prices to weak currency to now record low 10-year Chinese government bonds, economists in the West are optimistic. China is turning it around, they say. According to Bloomberg just last week, the outlook for China's exports is set to improve, buttressing growth in the world's second biggest economy, even as consumer spending slows, at least according to a Bloomberg survey of economists. Exports are expected to climb 4.3% this year from a year ago. That's not actually a good number. According to the median forecast of 22 economists surveyed over June 17th through the 24th. That's a jump from 2.8%. It's not actually that different from 4.3% in a May survey. China's economy may expand 5%, another not really good number, up from 4.9% projected in May, according to the median of 68 estimates. And none of that actually sounds all that impressive. So basically, Western economists are raising their estimates for Chinese economy because Jay Powell told them to. The U.S. is going to be having a second half rebound. Demand is strong and resilient. Europe is going to be recovering after a couple years of only stagnation, at least according to authorities. Europe is going to be improving. And so that, combined with the U.S. strength and resilience, that should get China's economy moving in the right direction. A good old shot of external demand. But in the very same article, it says, the survey findings contrast with a recent report by Goldman Sachs, which said its clients in China are increasingly skeptical about the outlook for export growth in the coming quarters, as well they should be. Investors are worried about the sustainability of supply-side expansion, especially when domestic demand is weak, and the risks of trade friction, the bank said in the note dated June 23rd. China is unlikely to shake off its deflationary pressures this year, with even economists becoming more downbeat about the prospects. So they're upbeat about external fact, the US and Europe, but downbeat about internal in China, which they have every reason to be. They expect the consumer price index to rise only 0.6% this year, while producer price index is forecast to drop 1%, both weakening from estimates in May. And this reflects consumers' reluctance to spend money amid concerns about their job security, income prospects, and falling property values, which sounds like a statement that applies not just to Chinese consumers. So economists are more optimistic about China because they're optimistic since Jay Powell told them to be. When people inside the economy can see where this is actually going. There is no external boost because this is a globally synchronized system. As China is struggling, that means downstream of China, there's going to be lots of struggling there too. But that China struggling is also a reflection on weakness in the Western economies like the United States and Europe. So China isn't actually going to be experiencing external growth or any boost in external growth because those Western economies aren't seeing it either. As I just mentioned in yesterday's video, unemployment is rising all over the world and it doesn't show any signs of stopping. Even a fellow like Mohammed El-Erian isn't buying this global hype, and he's usually one to cheerlead, especially the U.S. economy, soft landing and everything else. But just recently he said, the economy, talking about the U.S., the economy is slowing faster than most economists expect, and faster than what the Fed expected. The economy is slowing, and it has few buffers. A forward-looking Fed would certainly have the possibility of a July rate cut on the table. So China needs exports to save China, but many parts of the world need China to save them. And with unemployment, as I said, rising all over the world, where is the strength going to come from? A couple rate cuts from central banks here or there? It actually doesn't work that way. So China's woes have unique spin, but they aren't actually all that unique. globally synchronized weakness from all over the system. This past weekend, the Chinese government reported on the national PMIs for the Chinese economy. We've got manufacturing and services. And contrary to expectations, though quite predictable, the data came in exceptionally weak. Manufacturing was down to 49.5 for the second straight month, so more indicated contraction. Another contraction in new orders, continued contraction in export orders. So despite the expectations for a big external pickup, it's not actually happening. The services PMI. The services PMI came in at 50.5. And while that sounds good, it's on the plus side of 50. That's down from 51.1. And it's down substantially from earlier in the year with the Golden Week skews and everything else. But 50.5 is among the lowest for the NBS services PMI in its entire history, outside of the lockdown months of the pandemic era. So 50.5 suggests tremendous weakness among Chinese consumers in particular, but the entire services economy. So at least the Western economists are right about that. They can see weakness in that part of the economy, the internal part of the Chinese economy, just expecting somehow the US and Europe are going to combine to save China through an external boost that nobody else is actually seeing happening. Orders for services continue to contract at a substantial pace. Again, some of the worst numbers in the entire series outside of the lockdowns. And foreign orders for Chinese services, again, still contracting. And it's not just markets that are growing increasingly impatient about conditions in China. Businesses around China, as well as businesses from around the world that are operating in China, they continue to see only weakness, both externally as well as internally. While Bloomberg was talking about how economists are optimistic about China's prospects due to this export-led resurgence, those operating inside of China just aren't. In fact, not only they're not seeing it, they're increasingly pulling out of the country. In many parts of China, the warehouses and industrial parks that used to be a magnet for international investors are grappling with a surprising slowdown in business activity. It's surprising to those at Bloomberg and to economists, but it really isn't. It's been coming for all of this time, and we've gotten lots of signals for it along the way. Lots of signals for it. Logistics hubs that were built in anticipation of a long-lasting boom in e-commerce, manufacturing, and food storage are losing tenants, forcing building owners to slash rents and shorten lease terms. Shares of real estate investment trusts that own China commercial properties have plummeted, and some of their managers expect their rental income to fall further. So while China's residential real estate bubble has burst, there was a little bit of a commercial real estate, call it strength, at least during the initial part of the supply shock and the supply shock downside period. Because there was a lot of thought that maybe Western demand would keep up and we're going to need a lot of capacity from China in order to service it. But as reality set in over the last couple of years, it's become clear China's not turning around, nor is there actual strength in the global economy, including the United States. Instead, more and more businesses are realizing that what they thought was supposed to be recovery from 2020 actually isn't a recovery. It was artificial in every way, including the price illusion. As we move further and further away from it, what we're left with is what we see of the Chinese economy. A globally synchronized and growing downside. That China isn't just about China. Yes, they have their own problems. They have their real estate bubble, but even those are a reflection of weakness everywhere else. And that is reflected in what we see in Chinese government bonds. The lower bond yields go, the lower interest rates go in the market, the more of a negative signal that actually is. And even the PBOC knows it, at least for now, because a couple years from now, after the PBOC completely reforms, they'll be telling you that low rates are stimulus, just like Jay Powell does, and Christine Lagarde and everyone else. But for now, at least the PBOC knows low interest rates are a sign of distress and growing distress. And in China, there is no shortage over sources of weakness. So China bond rates are at lows or near record lows, and that's not a good sign. The PBOC knows it, but all it's going to do about it is, well, try to erase it, try to reverse the signal. They know they can't actually turn around the economy or the real estate sector, so they're going to try to scramble up the signals to try to build confidence in a recovery that the marketplace and the economy just doesn't have. They're going to create it from nothing. It's not a really good idea, which is why it's doomed to fail, among several other reasons. Markets have given the Chinese every chance to get it right, but it only comes out more wrong. China's economy isn't reflating, it's not recovering, nor is it rebounding. It's predictably getting worse and taking the global economy down with it. As unemployment continues to rise everywhere around the world, where is this strength supposed to be coming from? Lower rates from central banks? Even the Chinese central bank knows, at least for now, what lower rates actually mean. The head of the PBOC, Pan Gongsheng, confirmed recently that the central bank is being reformed into a more Western-style institution, which simply means it won't be a central bank anymore. Talked about that in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's anniversary sale. Big thank you to Eurodollar University members and subscribers. And until next time, take care.